The title of the first paper already tells you that we are right up to things when it comes to hot and current topics in asset pricing. And the first paper is titled Market Efficiency in the Age of Machine Learning. And Leonidas, the floor is yours. As I said, for 20 minutes, please go ahead. And
yes,
nice to have you with us today.
Thank you. Thank you very much for having me here. And thanks, everyone. I hope everyone is keeping well given circumstances. And let me get on this paper that, as you can see, is co-authored with three wonderful colleagues, Rui from WRDS, Tālis from Australia, from Sydney, and Saunders from New York. So this whole idea behind this paper is basically we test market efficiency using a novel data set that we obtained from Edinburgh, from the Security Exchange Commission, and we try to put a new framework of thinking around this particular issue. So the basic question we ask here is, as machines become more prevalent in financial markets, to what extent market efficiency, or more precisely, informational efficiency, is impacted? And it's not quite obvious whether market efficiency will be improved or deteriorated. So machines can clearly process more data, faster, and can be less susceptible to emotions and biases, and perhaps can read more complicated filings, and so on and so forth. On the contrary, machines cannot deal with soft information as human beings can. Overfitting machine learning models can result in trading on spurious correlations, and on the other hand, machines cannot produce new information versus humans who can, or gather new information or produce more information. So there's a trade-off between the speed and accuracy in decision-making, squeezing out slow and deliberating humans could come actually at the cost of accuracy. So this is the basic question and some basic, let's say, arguments surrounding the question whether replacing humans by machines in modern financial markets, to what extent information efficiency is impacted. Clearly, it's not obvious, and we start actually from the backbone of the paper. Actually, we start from a literature going back to Grossman, Stiglitz, and Kyle, and others, and information acquisition costs and processing. So basically, whoever puts information to gather more effort actually to gather more information is compensated in financial markets. And the cost of gathering and analyzing information has declined as machines replace humans in financial markets. We have a paper in JFE by Chen and Tal in 2020. And we also have this approach like increased computational power and the use of machine learning or artificial intelligence algorithms can help investors to overcome different problems in asset pricing models, or overcome or outperform, if you like, traditional empirical asset pricing models. There's a paper by Gu et al. Make use of highly unstructured data or textual data and front-run slower traders. So this is pretty much the theoretical backbone. The idea is that machines can gather more information and process the information harder, which is quite well, let's say, based on the original arguments by Grossman and Stiglitz that information acquisition matters, and the cost of gathering and analyzing such information matters as well. So basically, the paper is all about to what extent machines improve market efficiency nowadays. So let me make this quite clear from early enough. Our focus is basically on machines and different types of machines, as you will see pretty soon, cloud machine and other types of machines. So how we measure actually machines? What do we call machines in this paper? So we start from a unique data which comes from Edgar servers or the log file, and we focus on 8K filings of the US stocks, which are basically 8Ks actually report unscheduled material events or corporate changes, which are quite important to shareholders or the Security Exchange Commission. And such events could be changes to material agreements, acquisitions, mergers, change of directors, and others, as you can see here. So they are legally required to report such information. They provide a complete record of certain unscheduled information types, and these are filed with the Security Exchange Commission and made public via this particular server, the Edgar server. So just to give you an example, on July 2021, 2nd of July, we have actually this particular if you like, report. And as you can see here, there is a mix of hard, or if I can put it, numbers, and soft information, which appears in this particular 8K form. And there is a range of completely unstructured, or if you like, unstandardized to fairly standardized, let's say, information which is released through or via the form 8K. So you can see in here there is some information which is highlighted here that it refers actually to some, if I can say, some particular information with respect to some operations, and there are some other information which is harder, like numbers and so on. So the way it works here is we start actually from the company. The company actually files information to the Security Exchange Commission. The Security Exchange Commission, or the Edgar server, actually gathers all these 8K filings. And as you can see, there are different retailers, there are different cloud computing servers, database and media, traditional financials, and so on, who simply access this information, and the server actually access log file becomes public, and this leads to our research actually. So we start from company information which is released, the Security Exchange Commission organizes this information, people access this information, and what we are doing here, basically, we're looking at who is accessing this information. Is it cloud computing machines? Is it machines in general? Is it human beings? Is it database and media? Is it universities, regulators, and so on? So this leads actually to this log file, which is leading to our research. And the question is who accesses what info and when. So we have all of these detailed information with respect to who is accessing all of this information and when. So just to give you a quick idea of what this Security Exchange Commission Edgar server log file is, we start actually from 2003 to 2016. We have 14 years of data here. Data on each viewership or each viewing, referred as a visit here of an 8K. We have 4 billion visits, multiple terabytes of data, timestamps, HTTPs, status codes, and so on. So we use the IP address and we combine it with the maximum IP lookup, as in the paper by Chen et al. In 2020 in JFE, plus some ownership, plus capital IQ to classify users into different organizations, which can be, as you can see, cloud computer users, traditional financial institutions, database and media, regulators and education, and other. And we link all of these with financial data, with CompuStat and CRISP data, IBES, Refinitiv, New York Stock Exchange tag, and Security Exchange Commission MIDAS. So we use access patterns actually, and we use access patterns and reaction times to classify actually humans versus machine. So what we do here, if we have more than 5 downloads per minute or more than 1,000 per day, according to the paper by Drake et al., we classify as a machine, or more than 25 downloads per minute or more than 500 per day, again, based on the paper by Tissot et al., we classified as a machine, and the rest actually is classified as human visits. So just to give you an idea, a snapshot of the data, so you can see that the machine viewership versus human viewership over time. So from 2008 onwards, you can see an exponential growth of machine visits on the Security Exchange Commission Edgar server, according actually to the log file we have there, and human visits maintain their long-term average. And classifying, after we classify actually machines into different types of machines, like cloud machine, institution, investor, and inter-provider, you can see that the cloud machine is the one that is actually increasing exponentially over time by a large degree. So the first question we try to answer in this paper is, what info do machines access and what info humans access, and so on. So as you can see from this initial analysis we have here, humans drawn to negative sentiment. So basically humans pay more attention, if you like, to filings with negative sentiment or news. Machines are actually sentimental neutral. So as you can see, there is no any significant coefficient around actually the machine viewership, but there is for human viewership. Larger 8Ks measured either or based actually on the word count, on the number of, or the number of items in the 8K, receive more attention by both machines and humans. And both humans and machine viewers are less attentive to 8Ks published far from the event day. So basically, the companies have 4 days to report to the Security Exchange Commission this unscheduled or unexpected event. So the more we move closer to the deadline of that 4 days, we have actually less attention. So basically, the attention happens quickly, in other words. Humans pay more attention to bigger stocks and value stocks, and machines can, as you can see, uniformly pay attention to actually all types, if you like, of filings in this case. So there's limited capacity of humans, but must allocate anyway the scarce attention anyway. So we have some further work which is not appearing in this table, but it's in the paper. So by 8K content, humans drawn more specific, or if you like, anticipate info, but machines aren't. So humans actually pay more attention to filings which actually provide repeated information. Let's say when firms report actually, if I can say, earnings per quarter, and then there is a correction or an update on this particular reporting, previous recording, humans pay attention to that, although machines pay attention uniformly to all type of 8K. So the impact of market efficiency. Now we start from measures. So how we measure market efficiency, we use a standard the average cumulative abnormal return measure of Ball and Brown and Fama et al. So we measure actually the post-event price drift net of the predicted returns from a factor model. As you can see, we use a factor model here with K mimicking portfolios. We measure the inefficient or the efficient parts drift, but also capture the overreaction if present. So that's the standard measure. So we measure the drift, as you can see, as the absolute value between the car 0t minus the car 0.1. And
10 minutes.
The number of observations should be, the number of periods should be above 1. Yes, sorry. There's a question or something? I've heard.
I said you have 10 minutes.
Yeah, thank you. Thank you. I keep the time here. Yeah, thanks very much for reminding me. So a second measure that we use actually to measure efficiency here, we decompose actually the if you like, the price to different actually components. We have the discount rate, we have the market specific info, private specific and public info, and we focus also on the noise. And we take this part, actually the noise, as a dependent variable in some of our analysis. So basically, people who have access on the paper, you can see on the very last table on the appendix, we use this particular actually measure of efficiency. So as you can see, the first test here, the baseline regression, shows that humans actually, or if I start from machines actually do not add to the drift, but machines do. Humans do add to the drift, but machines do not. So more downloads by humans are associated with a larger magnitude of the price drift, although more downloads by machines isn't actually adding to the drift. So a standard deviation increase in human viewership is associated with 13.23% aggregate increase in the price drift over 20 days post to the event, let's say post to the 8K publication day. The cutoff day for us is the 8K publication day. And further on, we have machine types like the cloud machine, institutional machine, or data machine. And what we see here versus to basically when we look at the generic machine, when we boil down to a particular type of machine, the cloud machine or institutional machine or data machine, we see that increased downloads by of 8K filings by cloud computers, IT firms, and so on, is associated with a smaller magnitude. As you can see, this minus 0.02 here indicates that if I can say, the price drift is lower or is eliminated. So a standard deviation increase in the machine-based viewership of 8K from cloud computing services associated with 10.49 aggregate decrease in the price drift over 20 days after the 8K publication day. So this is the baseline results we have, the total machine and different types of machines here. And the question here is identification. So how we come up with causality stories here. So we have 3 identification strategies. We use actually the cloud servers or the cloud and power outages. So we exploit this exogenous cloud computing, if you like, server outages. And we also exploit outages like power outages and so on that affect humans. We have actually index additions, or if you like S&P 500 additions, so which disproportionately actually impact attention-constrained humans compared to unconstrained machines. And finally, we have instrumental variables, which are, as you will see later, rely down to sentiment and some other, let's say, instrumental variables we use here. We explain the fact that human viewership is constrained on high macro days. This is actually an evidence in the literature that humans on high macro news days, they pay more attention to macro news, and at the same time they pay attention to all type of news. So they are more attentive on these days in general. There is a paper RFS by Protopapadakis and Flannery, which is reporting this evidence. So it's concentrated on certain stocks, like certain types of stocks influenced by sentiment, but machines aren't. So basically, these are the three identification strategies we have, that power and cloud outages or cloud services are fairly robust, but actually they go down, obviously. And all of these three identification strategies confirm our main actually result that we have so far, that cloud machines improve efficiency or price efficiency. We can see from here, for instance, when we have cloud outages and power outages on the column 7 to 12, we have actually the idea, we see actually that when we interact the cloud machine with power outages, you can see that the cloud machine, instead of improving market efficiency, disimprove market efficiency. So basically we have the coefficient, which is positive and highly significant in both models 1 and 4 here. And the same happens actually when we have the general machine. As you can see in here, we have cloud machine, down here we have machine. And also the same happens when we have the power outage as well. So this is the first identification. So during cloud service outages days, the relationship between cloud machine viewership and drift is less negative. So the next one is the inclusion to S&P 500 index. So again, after index inclusion, the relationship between human viewership and price drift is less positive. And index inclusion attracts actually more sophisticated investors whose viewership actually is more likely to improve market efficiency than the average human visitor in a way. And lastly, the instrumental variables, like I said before, we use these 4 instruments like the sentiment, macro news, the path returns, and the VIX. And we come up actually with the expected value of human viewership, which is plugged in the second stage, and we see that the human viewership here appears positive and statistically significant. So now we talk about mechanisms. So what really drives this result? How actually we move from machine viewership to a particular mechanism which leads to price efficiency. So we have actually 2 mechanisms here. The first one is the probability of informed trading. So basically machines versus humans. Machines improve the probability of informed trading. So basically machines bring actually or process information faster and simply access to more information, and we have a higher probability of informed trading, if you like, here. So we can see it on the pin 01 and 05. It's quite evident. And the second actually mechanism we have here is the algorithmic trading. So cloud machine leads to algorithmic trading post to 8K, but human viewership isn't. So as you can see, the human is negative, the cloud machine is positive and significant. So these are the 2 mechanisms we have here. So again, machine viewership leads to more informed trading, but human viewership isn't, and cloud machine viewership leads to higher algorithmic trading, although human isn't. And lastly, I'm going, sorry, 5 more minutes?
3
minutes? Okay,
yes.
Good. So lastly, the last question is, when do machines have an edge, or when do humans have an edge? So in other words, we have actually 3 tests in here. The first one is related to sentiment. So basically, we have actually, it's a known fact that emotion interferes with decision making, and we have humans struggle to process bad news rationally. We have papers reporting this, like Dettmar in 2007, of excessive optimism. So there is an asymmetric bias here. Machines should not be affected from this asymmetric bias, but humans do. So the question then is whether actually machines can handle negative sentiment more efficient than humans. So machines might contribute more to efficiency in high sentiment settings and high pessimism bias settings. So we have actually done a test, and what the data confirms here is machines have stronger impact on efficiency in filings with many negative words, which are picked up by Laurent and McDonald's work. So we can see in here that the cloud machine times the negative, actually the sentiment actually proxy in here is improving market efficiency, although humans aren't. And the second one, it has to do with the sequential or repeated information. We start from the theoretical premises of the work by Dugas and Foucault. So there's a trade-off between fast and noisy and slow and accurate processing of information. Many machines are trained to respond quickly to information in isolation. And basically what this model predicts is that whenever a given announcement takes place, the price can go up and down. And the idea here is that machines can squeeze out in slow and accurate processing of information based on the trade-off of fast and noisy. So what we have in the data here is we look at the item 2.02, which is reporting financial information in an unscheduled format.
1 minute.
So yeah, I'm finishing off. Thank you. So we have actually the item 2.02, which largely repeats previously disclosed information, financial information, and humans are more effective than machines to process such information, which is combined with information that has already been released at the previous period. So what we see here is that humans times the item 2.02, we see that market efficiency is improving here, although for machines, this isn't the case. And lastly, we have the measure of readability. And what we find from here is that machines are better able to handle information which is harder to read for humans. So the idea here is that when actually we have complicated filings, machines can process that information faster. And in conclusion, what I can say is that the most sophisticated machines, which are the cloud computing users, consistently improve market efficiency. Not all machines are benefiting market efficiency in the same way. The channel that we provide is through the informed trading and algorithm trading, and the mechanisms, like I said before, are down to these two. So machines excel when humans are more prone to bias or to pessimism, and humans are constrained on that, or are constrained to small stocks, busy days, and so on. And humans can have an edge, can excel, if you like, when combining sequential information that overlaps across different points of time, and also when they simply process soft information. And that's it. So yeah, thank you very much for listening. That's all I had to say. I hope you're convinced, and stop sharing my slides. Thank you.
Thank you, Leonidas.
So I hope I'm on time.
Yeah, sort of. Yeah. The discussant is Julian Thimme, and I saw that Sönke Batran probably has a question, but I think we should delegate this to the 5 minutes of public discussion, if that's fine. So I would suggest that Julian goes ahead with his discussion first.
So thank you very much. Yeah, hi everybody from my side. It's a great pleasure for me to discuss this very, very interesting and very creative paper. Algorithmic trading accounted for 73% of the trading volume in the United States in 2009. That's 12 years ago, so probably this figure has increased since then. So it's obvious that algorithmic trading is something that we should think about. So we should think about the impact of algorithmic trading on figures in the financial markets. For example, Hendershot and Quarthes have already talked about the impact on liquidity. They've said that for big stocks, algorithmic trading actually decreases spreads, so arguably liquidity should increase with the rise of algorithmic trading. For prices, this is not so clear. So you could think about a scenario where algorithms basically just do the same thing as humans, and they're just a couple of milliseconds faster. So in that scenario, prices will probably not impact it materially, right? So this is really, I would say, an open question. And this paper is one of the first, or maybe the first paper with a serious attempt to address this question. And the results are pretty clear. So this paper shows that algorithmic trading activity improves market efficiency. Okay, so it means that when algorithms trade, the price drift after the dissemination of new information, firm-specific information, is reduced. Okay, so imagine there's a firm that issues new information, and typically what we see is that it takes a couple of days or weeks, at least when algorithmic traders are not there, so that this information is incorporated into the prices. So we see this kind of price drift of several days. And this drift is reduced when algorithmic trading activity is high. So here, algorithmic trading activity is measured via downloads of 8K filings by cloud computing service providers, like, for example, Amazon Cloud Services, which is arguably the place where most of the algorithmic trading actually takes place. Okay, so that's the punchline of the paper. That's the main result of the paper, the main takeaway from the paper. And then there's a second result that says that human trading activity actually hampers market efficiency. Okay, so same design, when humans download 8K reports, when they download information, means that the price drift is increased. Okay, that's maybe not so important for the main message of the paper, but it's still a very interesting finding. And I think it's also pretty counterintuitive, difficult to explain. Okay, to sum up the main points of the paper, first of all, they start with a fantastic data set, which contains downloads of company filings from the Edgar database at the SEC. And it provides company IDs, timestamps, and downloading IP addresses of the entities that download the data. So the author can really say, you know, this download came from, for example, a cloud service, so arguably an algorithm that also wanted to trade on the information afterwards. So this is really fantastic, but it's also fantastic what the authors make with this data set. The empirical approach is to only look at downloads on days of unscheduled news, so really news that comes into the market. And the idea is that human and machine downloads proxy for human and machine trading activity. At least that's my intuition, how to interpret the results. The findings, already as I said, the main results are that the price drift after a news release causally depends on the absolute number of machine downloads. That's a negative relation. So machines download a lot and the price drift is less pronounced. And it's the other way around for human downloads. There's a positive relation. And importantly, we're not talking about relative numbers here, we're talking about absolute numbers. So those are really two independent results. It's not the case that automatically when machines download a lot, then humans download less or something, right? So those are really two different findings. So in my discussion, I also want to first talk about the first result, and then afterwards, I'll talk about the second result, which I think is more surprising. Okay, so let's first of all talk about the first and I guess the more important result, that machine downloads cause markets to be more efficient, or more algorithmic trading cause markets to be more efficient. So the design, as you've already seen in the presentation, is to regress the drift on the viewership, so the number of downloads, plus some controls and fixed effects. And we see a negative relation when we look at cloud downloads, so downloads from cloud service providers. Okay, so significantly negative effect. And here I have a minor question, actually. I just wanted to know more about the distribution of the viewership data. So panel one, table one, panel B, maybe you can add a little bit more of are there extreme outliers? These results are driven by a couple of observations, stuff like that. Okay? But that's a minor comment. First, when I saw the main result, I thought maybe there's something like an alternative reverse causality story here. Maybe the high drift tells us that there's a lot of uncertainty about the fundamental firm value. And so maybe it's difficult for machines to predict where the price is going, and that's why they do not download 8K reports in the first place. They don't even give it a shot. But that's not the case. Okay, so the authors do a very good job in providing a causal interpretation here. And for me, the main point, what convinced me most, are the cloud outages. So those are days without cloud service. So here in the empirical baseline regression, they include an intersection term between the viewership, so the number of downloads, and an indicator function, which is equal to 1 on days without cloud service. Okay, and then they find that the baseline result is still in place. So we see a negative beta, but we see a positive gamma, which tells us that the impact of machine viewership on the drift is less pronounced on days where algorithmic trading cannot take place because the cloud service is not running. Okay, so this is really a cool result. This is really establishing causality here, unless you believe that, I don't know, the cloud outage is on that day when, I don't know, certain firms want to issue information. So this is really, yeah, it's really a strong causal interpretation here. I have a couple of questions. First of all, I would like to see descriptors on the cloud outages. You just said in the presentation that it happens hundreds of times. This would be really interesting to have more information on that. Also, power outages. I thought that power outages are probably very rare in the United States, but yeah, it would be interesting to learn more. I found it puzzling that the delta is negative. So here that there's a negative effect of the cloud outage itself on the drift. So why would that be? Is that just random? And then I was wondering if there's an extreme negative correlation between machine viewership and this indicator function, because I think when there's a cloud outage, it's not only impossible to trade, but it's probably also impossible to download. Okay, so in the extreme case where the outage takes keeps on for 2 days, okay, so it lasts for 2 days. Of course, it would also be impossible to download on these 2 days, right? So in that case, this intersection term would always be exactly equal to 0, because whenever the indicator is equal to 1, downloads must be 0, right? Of course, this is not the case because maybe the outage only takes place for a couple of hours, right? And afterwards there's viewership. But I still was wondering if there's a mechanic relation between these two variables and if this may have an impact on the interpretation of the results. Further interesting findings. The relation between machine views and the price drift is more pronounced for difficult to read 8Ks, for negative sentiment 8Ks. Here I was missing actually the baseline effect, the second result, that you also include sentiment alone in the regression. Now I just saw in your presentation that it's also included, but I think in my version it was not included. Okay, but I don't know if this is maybe a new result or so. So I don't want to talk more about it because I just saw in your presentation that the actual effect that sentiment has on the drift is there. So lower sentiment means higher price drift. Then machines come into play and reduce that price drift because they are not so sensitive to negative sentiment here. And what's more, machine views are positively related to measures of informed trading and to measures of algorithmic trading, which is of course reassuring because I think that's the channel that we always have in mind, that when they view more, then there's also more trading. Okay, so main takeaway here, machines improve market efficiency because they are more informed and faster than humans. That's the main takeaway from the paper, and that's the first interesting finding. Now let's talk about human downloads, which make markets less efficient. Same empirical design. Here the coefficient is positive. So that means when there's more viewership, then the drift is more pronounced. Okay, so arguably markets are less efficient. Importantly here, it's not relative to total downloads. So all else equal, more downloads by humans make markets less efficient. I think that's a very surprising result because my intuition is that inefficient markets are related to slow information diffusion, and slow information diffusion should be related to less informed human beings, right? So when humans download more, my intuition is that they get themselves more informed, and then they should also trade on that information and maybe then incorporate these informations faster into prices. So this was really something that I found puzzling. So my first intuition is that maybe this is again something like a reverse causality story. It's very easy to come up with such a story to say, the drift is high and there's high uncertainty about the fundamental firm value. So information about the firm statements, the AK reports, is probably hard to understand for humans.
5 minutes.
Thank you. And so there's high downloading activity by humans because they want to understand better what's going on and trade on that, right? But here again, it's a very elegant approach to establish causality here with an instrumental variable approach. Again, this was the one that convinced me most. Human viewership is instrumented, for example, by simultaneous macro announcements. And to get the intuition here, when macro and firm announcements happen to fall on the same day, then humans are arguably too busy with the interpretation of macro announcements, so they cannot focus, don't have the capacity to also understand the firm announcements. That's why on these days, the downloads are reduced, so we see less downloads. And on these days, the price drift is also reduced. Okay, and that's really very, very neat, this analysis, this piece of evidence, because this really establishes causality, because it's very unlikely that, I don't know, you make up a story that I don't know, firms issue information on exactly those days where macro announcements take place to, I don't know, reduce the price drift or whatever. I mean, that's really absurd, right? So this really makes sense that there's a causal relation in the direction that the paper wants to show. But I find this really surprising, as I already said, because for me, like, the issuing of an unscheduled AK, so the release of information, should lead to an update in the fundamental firm value. And usually in these market microstructure models, we always have an exogenous fundamental firm value. You know, you say there's something like information comes in and now the firm value is $100, or the stock price is $100, something like that. In reality, though, the fundamental firm value is not exogenous, right? So in reality, the fundamental firm value is a price that humans agree on by trading in financial markets. So here's something like a like a toy model or so, a simplification. So assume we have different human traders in financial markets, and they have different distribution of marginal utilities. And there's a new asset coming in. This asset hasn't been spent before, so market's incomplete. So all of these guys have different prices in mind before trading, right? And then maybe they start trading, they insure each other, and then they agree, by trading, they agree on a price in the end, right? That's the mechanism I have in mind, how prices are formed in the financial markets. Then there's news, an update in the distribution of cash flows. Again, they have different prices in mind before trading, then they start trading. And in the end, they come up with a price they agree on, right? That's what's going on. The first result of the paper, that machines can actually make markets more efficient, makes perfect sense to me in this rationale here, because, you know, whenever they're trading, machines come in and they say, you know, I know what's going to happen. I can predict, because I have some information about the distributions of marginal utilities of the humans in the market, and I can predict what humans will agree on. So I can kind of predict the behavior of the humans, and that's why machines can profit from trading here. Okay, they can profit from trading because they can predict the human trading behavior, basically. This can perfectly explain the first result, but for the second result, what does human viewership actually stand for in this model? Okay, is it the act of trading to agree on a price is more complicated, is more involved? Probably not, right? Because this would imply, again, reverse causality. It's really difficult, at least from my perspective, it's really difficult to understand in this like kind of rational setting where this causal effect of human viewership on the drift comes from. Only explanation, thank you, to explain that is actually that there are also humans that try to understand what's going on and also try to trade on the trading behavior of the fundamentalists, right? But they try to trade on it, but they fail. Because that's the only idea, it's the only possible explanation that I can come up with, that VH, so the human viewership, actually proxies for the trading activity of some speculators and noise traders. Okay, they try to trade, but they fail. But then the follow-up question is, of course, why would machines not trade against these noise traders? It sounds like a super simple task. Human viewership is highly predictable. That's what we know from the baseline first result of the paper. Humans trade in big stocks, in value stocks, and stocks with low institutional ownership. So it should be very easy to for machines to trade against these guys. So in that case, machine viewership should co-vary with human viewership, right? So I would find it very interesting to see a regression analysis where we regress machine viewership on human viewership and some controls to see if machines like jump in when they know that humans trade a lot and that machines trade against these guys. Apparently, this is not the case, at least not perfectly, because otherwise the viewership would move in lockstep, right? I'm done. Yeah, that's my very last statement here. So I was wondering, why is this not the case? So I think we need to understand better the decisions of humans and machines to trade stocks for non-fundamental reasons to time the market. This is the paper makes a fantastic step into this direction, but still I don't really understand why machines move into certain stocks now. Right? This is just what I wanted to say. I have a couple of random rants and questions, but in the interest of time, these are just minor things. Let me just say that this is a fantastic paper with a fantastic data set and a very important research question to look at the impact of market of algorithmic trading. And I think it's a great idea to approach this question this way using downloads. And the authors do a very good job in establishing causality here. So I definitely would recommend this paper to everyone who is interested in these kinds of questions. Thank you very much, and sorry for taking more time.